The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's got Qantas frequent flyer points, but he doesn't know how to use them. It's Anthony McDonald. How are you, Anthony?
Platinum for life points dummy, James.
Absolutely. Well, this week we look at how the RBA could be coming for all of our Qantas points. We ask why one of Australia's biggest listed retailers sacked its CEO, and we take a question on the Federal Reserve's latest rate cut and what it means for the Magnificent Seven. But Anthony, let's start with some big news in the world of corporate deals and what would have been Australia's biggest ever cash bid, a $36.4 billion offer for Australian energy producer Santos, sensationally fell over late on Wednesday night after nearly 3 months of due diligence. Anthony, this was a bit of a surprise. What went wrong? And do we think Santos and its bidder, which was a sovereign wealth fund out of the United Arab Emirates, parted on good terms or bad terms?
James, I think someone's got eyes bigger than their stomach.
Not just me.
The UAE's XRG, as it was called, an entity owned by their national oil company. So we're talking about sovereign money here, James. It wanted some LNG assets. It wanted an actual operating business, not just a little gas field here or there. It liked the look of Australia. Apparently, it's really keen to invest in Australia and help unlock domestic gas and help all Australians. So it came here pretty much unknown, sight unseen, a new entity out of a sovereign wealth fund, fishing in a new territory with private equity in tow, and has absolutely blew its top off with a $36.4 billion bid for Santos. One of our two big energy producers. Now, Santos' board, to their credit, they pushed it pretty hard. When these guys turned up, they offered one price and they said no, another price no, another price no, another price okay, you can come in and take a look. They ended up $36.4 billion bid for all of Santos. That was 3 months ago, James. Due diligence started, 2 extensions later, and with due diligence due to run out for a third time at the end of this week, Santos' board said, come on, guys.
Time to put up or shut up.
Are you serious or not? And XRG still wasn't ready to sign the deal and was put off by a few things and it all just couldn't come together. So they did the old shove it, Jack, I'm walking out your effing door, as Paul Kelly would say, and took its $36.4 billion with it. So, Santos is miffed. XRG just didn't live up to its own promises and promised to, act quickly and get this thing done. XRG, I think they're miffed. They definitely didn't want to turn up and then not follow through, and they think they found a few things that made them a bit doubtful. So there is one person, James, that will be breathing a sigh of relief through all of this.
Yes.
The Treasurer, Jim Chalmers.
Of course.
He doesn't have to make a call, right? And this was going to be a contentious one. Should a sovereign-owned investor be buying such a big Australian company, a big Australian energy producer, an important player in our energy markets? So it's a bit of a kerfuffle, right? And history will probably look back at this one as a storm in a teacup. This is the third Santos potential takeover I've covered. There's no other big Australian company. We've covered 3 potential takeovers and they've all fallen over. What did you make of it?
Well, Santos was out there saying it's not us, it's them. Yeah. And I guess XRG was giving a version of the same thing. But as you say, when Santos has had 3 bids that haven't ended up getting completed, the it's not us, it's them line does wear a little bit thin. So I think you can make a rational explanation for all those bids falling over. The first one was from a private equity firm called Harbour Energy. They didn't seem to quite have the money or as much money as they needed. The second one was from Woodside. As soon as the Woodside shareholders found out about a bid for Santos or a bid for a Santos merger, they sort of put the kibosh on it. And then this one's fallen apart too. Anthony, just say, really big deals in oil and gas are really hard for all those sensitivities that you mentioned. Is that the lesson here?
They're hard to do, James, and they're particularly hard to do when they leak.
Yeah.
And you might remember this deal leaked, right? So for whatever reason that it leaked a couple of months ago, and that's what was the trigger to get this thing done, clearly someone in there wasn't happy at the time with the progress that was being made, right? So the deal gets out, it leaks, and then the whole thing starts. That's 3 months ago now, James. So I think the first lesson is when a deal leaks, be careful, right? There's something a bit funny going on. They're a little bit frustrated. Maybe both sides aren't as willing to deal as you think.
Yep.
And the second one is the time kills deals. 3 months on from due diligence starting, the fact that XRG wasn't able to stand this up quickly like they did, it's always a bad sign, James. It always shows some sort of hesitancy or doubt, and the extensions come through and these things always get spun. Nah, everyone's happy, it's all good, etc. Well, guess what? It's not. If it was all good, the thing would have been done.
Yeah.
So we got to remember the basics.
Well said.
And James, it's not a Chanticleer podcast episode at the moment without a bit of ANZ news. So fresh off the 3,500 job cuts from last week, the ANZ this week cut a $240 million deal with ASIC, the corporate regulator, to settle for a bunch of bad behaviour in its markets and retail businesses. James, what did ANZ do to get fined, and how significant is $240 million in penalties?
Well, it's the biggest single penalty that ASIC's ever extracted from one entity, so they're on world record pace here. It's a big number, but there's a bit of pragmatism here on both sides, right? ASIC loves a big scalp, no doubt about that. It's always good to say we've just got the biggest fine out of these guys. That makes the corporate cop looks pretty tough. But ANZ had a reason for sort of whacking all these misdeeds together. So what they've been fined for is, one is for this bond market scandal. So they were one of the banks involved in selling Australian government bonds. ASIC, and this has been agreed, that there was some misreporting of ANZ's role in that. And so they've paid about $125 million in fines for that.
Jeez.
The rest of the fines are for a series of problems in the retail division, including not paying bonus interest that was owed to people, mishandling of hardship claims, and mishandling of deceased estates claims. Now, that's frankly pretty sloppy stuff. It belongs back in the Banking Royal Commission. Really embarrassing. But the fact that ANZ is willing to put all of these misdeeds together and settle them all at once, why are they doing that? Because they want to clean up all this stuff all at once so our old mate, the new CEO, Nuno Matos, can get on with his turnaround of the bank. He's tying this all up in a nice little package and saying, yes, we were very naughty bankers, but that's behind us now. Please look forward at my new strategy, which I'm going to announce on October 13. So that's a pragmatic strategy from ANZ. I think investors and analysts generally liked it. Take your medicine all at once, move on. And certainly that was the message from the chairman, Paul O'Sullivan. He doesn't want Nuno Matos relitigating the past. He wants him focused on the future. That's all good. But sorry, I'm not going to applaud ANZ for tying this up in a neat little pragmatic bow. This is stuff that just shouldn't happen. In banking, all your customers are important, Anthony. But is there a more important customer than the Australian government? The government that hands you your licence? You just don't mess around with anything to do with the government. You're squeaky clean. And unfortunately, ANZ hasn't been squeaky clean with the government. And similarly with your retail customers, you don't want to be caught doing this silly, sloppy stuff. I think this does say that ANZ really does need to lift its culture and accountability. Nuno Matos has promised to do that. Paul O'Sullivan says that's a work in progress. We will do better. But this is a real rap on the knuckles, and ANZ, while they've dealt with it in a clever way, I guess, I'm not going to be applauding them much. Sorry, Anthony. I don't know what you thought.
I'm with you. It's a privilege to work for any client, let alone the Australian government. $240 million, right, it doesn't sound like that much for a bank that's worth $100 billion in market cap and it's got a huge balance sheet. But that $240 million has to come from somewhere, James. And as usual, it just comes out of shareholders' pockets at the end of the day, right? That $240 million, it could be money used to grow ANZ's loan book. It could be used to invest in tech, buy frequent flyer rewards for customers, give staff a $3,000 each package of shares, perhaps even return it to shareholders in a 5 cents a share dividend. But instead, it's being sent to ASIC. So, yes, ANZ's a big bank. Yes, it's big, strong balance sheet. Yes, it can go out and raise debt anywhere it wants in the world at any time, and investors will give it to them. But pouring $240 million down the drain on these penalties, that's not good capital allocation. And this whole thing may be good for the new CEO to effectively wipe the slate clean. But for anyone that's been at ANZ for more than a few months, right, and we're talking about all the shareholders here, it's just not a good use of funds.
Absolutely. Now, Anthony, this will be, well, maybe not one of the last things ASIC chairman Joe Longo does, but he's announced on Friday morning that he's going to step down in the the first half of next year when his tenure ends. It was a bit like Philip Lowe, the RBA governor, did this time last year. You know, these contracts come up on different cycles, and Longo's decided to not seek reappointment. What did you make of his tenure? It's always a tough job being the corporate cop.
It sure is. It's 5 years, and I guess it shows just more change in a big institution. We had the change at the RBA, ACCC, Treasury, now ASIC. I find it really interesting, James, and I think the politicians at least and the public more broadly still want ASIC to be tougher on big business. And I think Joe Longo's started that, but I mean, look at ANZ, look at their behaviour. Do you think they were scared of ASIC? Look at Macquarie and the repeated violations they've been caught out from. Do you think they were scared of ASIC? So I think we're still looking for the corporate regulator to get tougher. I don't know. Am I being too mean?
Oh, no. I think you're right. The public does want a tough cop on the beat. My view of ASIC and of Longo's tenure is coloured, I think, by all those hours I spent in courtroom 4A down at the Melbourne, the Federal Court in Melbourne, watching the Banking Royal Commission. And back in those days, we heard all these stories about how ASIC, you know, when they were drafting a "you've been naughty" press release about a bank, they'd send it to the bank before they send it to the media, just to make sure the bank was happy with it. I mean, what I will say is since then, ASIC's been through this tumultuous period where James Shipton was the chairman. That was pretty messy with his exit. Longo steadied the ship, and I think he's sort of got the balance pretty right between plenty of enforcement, keeping the systems safe and stable. And I think he's done a few things around the way markets operate and corporates operate that we will come to appreciate later. You know, he's asked the question of why don't we have enough IPOs? Is there anything I can do about that? That's not something we've seen ASIC do. He's asked the question, is there too much regulation from my end, and what could I do about that? So again, I think a bit of applause for that. You're right, though. Should ASIC do more? I think always is the answer. Longo himself would acknowledge that there's always more you can do, but he's done a reasonable job of getting the balance right, I reckon.
All right, James, let's get to our first topic. And in a big week of corporate news, one story certainly stuck out, and that was the brutal sacking of the CEO of Super Retail Group, a $4 billion company that owns a string of household names such as Supercheap Auto, Rebel, BCF, Macpac, and others. CEO Anthony Herity was officially given his marching orders for failing to be completely truthful about an alleged romantic relationship with the company's former Chief Human Resources Officer, a woman called Jane Kelly. Anthony Herity was pretty well regarded in the market, James.
Yeah.
Super Retail is a big company. It makes a few $100 million a year profit, pays good dividends, and its shares are up 60% in the past 5 years. He was generally accepted to be good at his job.
Agree.
But that relationship with Kelly has sparked an epic saga that's involved two whistleblowers, lawyer-on-lawyer violence, questions of corporate governance, and now the unceremonious sacking of a highly regarded CEO who's been stripped of his bonuses and his options. James, can you take us back to the start here? How did this mess develop?
Well, stick with me here because this is an incredible saga. So go back to April last year and Super Retail Group, as far as we know, doing its thing, selling lots of fishing rods and camping gear, all going fine. But then in April last year, they suddenly put this release out and they say, hey, we are about to be hit with court proceedings that'll throw up a range of allegations, bullying, victimisation, and the non-disclosure of this relationship between the CEO and the former HR manager. We reckon these lawyers, a law firm called Harmers, and these two complainants are going to try to take us for 30 to 50 million bucks. But we're getting on the front foot. We don't think there's anything to see here. We've done an investigation. It's all good. We're going to defend our CEO to the hilt. So that was the message from Super Retail. So we roll forward and eventually we do get two federal court cases launched by two former executives, a former chief legal officer, Rebecca Farrell, the former chief company secretary, a woman called Amelia Bercazelli. So these are still working their way through the court, and Super Retail's frankly pretty aggressive in their legal strategy. There's an alleged settlement, or there's a settlement that's discussed last May, but it falls over. And then in June and August, the entire board of Super Retail, including Herity, the current chairman Judith Swales and the former chair Sally Pitkin, they issue concerns notices against Harmer's law firm and the two complainants, threatening to sue them for defamation.
Yeah, right.
So this is all getting very messy. It's all supposed to go to court starting in late September and going through to next year. But then, on Tuesday, we find out that Super Retail Group has terminated Herity's employment instantly, slashed all his bonuses. Why? Well, new information's come to light about this relationship with Kelly. It's been put to Herity, and he's had to fess up. Oh, yeah, didn't quite tell you everything about that. The board has basically said, sorry, not good enough, you're out the door. And here we are. What an absolute mess. It's just one of those incredible stories. And I think what's made it so incredible is that the company went on the front foot and in such a public way took these two female whistleblowers on.
Yeah, wow. You've been all over this for more than 12 months now, James. It's blown up this week, but who shoulders the blame here? Is it Herity or is it the board?
Oh, well, I think you've got to start with Herity. I mean, it's one thing to have a relationship with someone at work. I think it can be awkward. There's certainly some power dynamics that you'll always need to consider. But if it's disclosed properly, a relationship between two consenting adults isn't the end of the world. But this one wasn't disclosed properly. What we've learnt this week is that Herity didn't tell the board the full story about this relationship. Now, I just think about that and I think, where's your personal sort of responsibility? Where's your responsibility to your investors and to your fellow board members who you're in the same boardroom with? Like, what was he thinking? Oh, maybe the whole story won't come out and I'll get away with this. I mean, seriously. Transparency between a board and their CEO is just absolutely paramount. But again, the board takes some blame too. Like, why weren't they a bit more sceptical about this whole story? Why did they get on the front foot and decide to sort of launch this lawfare against these two whistleblowers instead of just waiting for the claim, assessing the claim, figuring out how the claim could be settled or dealt with? I just think this is a disaster on all sides, Anthony. It's just a mess. But what do you reckon it says about Australian office or business culture? Is the office romance dead?
What a question, James. This is new areas for the Chanticleer podcast. The office romance. This isn't an Australian story. This is a life in 2025 story.
Yeah.
Look what happens in the US or Europe. I mean, look at the Coldplay Kiss Cam incident.
Good point.
One of the top global business stories of the year.
And again, that one was a CEO and their HR manager.
Totally. Look at Nestle. I don't know if you've been following that one.
Yeah.
One of the world's top consumer companies fired its CEO a couple of weeks ago after conducting an investigation into an undisclosed romantic relationship with a direct subordinate, James, that breached the group's code of conduct. And this week, the Nestle chairman went as well. Oh. 2 years ago, BP's boss resigned after failing to reveal a relationship with colleagues. And the company then docked him or clawed back $40 million worth of pay. So, James, this is going around, right? This is just business in 2025. And, of course, these stories are all a bit different, but the theme's kind of the same. And
yeah.
For me, James, this isn't about the office romance being dead. I think and hope people fall in love at work forever. It means we all haven't been replaced by AI. But I'm not sure office romance is a ban, like far from it. Hilariously, I had a conversation with a director of two ASX 100 companies about this a couple of weeks ago. This guy's of the view, no, it's absolutely, the office romance is not dead. I mean, that's not what's going on here. This is all about power imbalance and corporate governance, isn't it? It's about top-line executives, what happens around these romances and just the fair treatment of people. And that's why these things are coming down to disclosure. That's why companies require disclosure.
Yep.
We're not seeing a spate of unfair dismissal cases over office relationships as such. And surely they're still going on. So I don't think the office romance is banned. And just out of interest and having read your column on Super Retail, I did look up Nine Entertainment's code of conduct, James, just for what's required in here.
Yes.
Not that I'm looking, but I just thought it's interesting. And the theme's basically, relationships happen. That's fine. You just got to be transparent and professional about it. You know, 3 things: flag it early, keep it fair, stay professional. That's where we're at in 2025.
No, that's exactly right. Yeah, it's all about disclosure. All those cases you mentioned are about disclosure, transparency, who knows what when.
Exactly. So, James, Super Retail, let's get back to them. Does this saga have further to run? And what does it mean for Super Retail's shareholders?
Well, Super Retail shareholders have lost their high-performing CEO. I mean, there's going to be one of those inevitable global searches to replace Herity, and there'll be disruption to the business. There can't not be disruption to the business. What does it mean for the board? You'd think they'd be spending several weekends or several board meetings in the Hall of Mirrors, taking a pretty good hard look at themselves. And think about, Anthony, these legal cases that Super Retail's been, aggressively fighting. You can only think that they'll be settled pretty quick smart with pretty big settlements. In fact, Anthony, the irony here, think about it. I reckon there's a ballpark estimates. I wouldn't know, but it wouldn't surprise me if Super Retail has spent $10 million on legal fees so far. Now, you think about the settlements and the further legal fees that they'll have to cop. It wouldn't surprise me if that accounts for another $20 million. So all up, this will probably cost $30 million. Do you remember how much I said back in April 2024 the company warned that they could be taken for? 30 to 50 million. What's it going to cost them? 30 to 50 million. Oh, and a CEO, and 12 months or 2 years of distraction, and a lot of reputational damage. I mean, what a shocking effort. Just red faces all round on this one. No winners. And spare a thought too for the 2 female whistleblowers who've been put through hell, been sort of taken to the legal mat on this. And for what? The Super Retail Group's position has been so weakened by the sacking of Heritage. The whole thing is it's a mess. I mean, for those 2 women, it's an absolute tragedy. We should remember them in all this, I reckon, too.
Well said, James.
Anthony, for our second topic, let's look at one of Australia's great magic bean stories, Qantas frequent flyer points. Australians rack up billions of Qantas frequent flyer points every year, 222 billion just last financial year alone. And these are from flights, from spending on credit cards, from handouts from retailers and utilities, and all sorts of other transactions. One of the biggest points generators is spending on credit cards. Qantas reckons points earnings cards accounted for more than 35% of all spending on cards last year, which is why we see all the major banks and American Express try to lure customers with premium cards tied to Qantas points. Anthony, this really creates a very, very powerful business for Qantas, and it's called Qantas Loyalty. Can you tell us how important Qantas Loyalty is to the broader airline group?
It's highly material, James. It's almost like the amplifier that makes Qantas's performance a whole lot louder. The fuel in its flywheel, as you would say, James.
Yes.
Someone who hangs out with the CEOs. It's all about the flywheel. It makes the flywheel spin faster and stronger. James, Qantas used to have frequent flyer points, as rewards for flyers, keep them coming back, a way to rank their customers, create this status thing, who to look after, who not to, sort of gamify the whole experience for customers, give them something to strive for. There's some prestige and rank to attain. But it's really grown into a lot more. And Qantas has been ramping it up in the past decade or so. Realise these magic beans that it sells to other customers. The people like frequent flyer points, customers love accumulating them.
Yeah.
Even if they don't know how to spend them or they can't find flights to spend them on. So now you'll see Qantas frequent flyer points used as a bait for all sorts of things. Woolworths, you get about half a point for every $1 you spend.
Yeah, yep.
Now, that doesn't sound like much, James, but someone you and I know very well, it keeps him going back to Woolworths every Saturday just for those points.
Yeah.
BP, 2 points for every litre of unleaded petrol that they sell.
Yep.
LJ Hooker, real estate agent. You can earn 20,000 points if you list and sell your house with LJ Hooker. Did you know that, James?
No.
Mate, car hire, hotels, utilities, all this sort of stuff.
Yeah.
It's amazing. So Qantas Loyalty, the business itself, the frequent flyer division, reported $2.9 billion in revenue last financial year and $556 million in underlying earnings. Wow. Now, that's huge. That's about half as much as Qantas makes on its powerful domestic airline business, just for context, or similar to what it makes on international flights. So this loyalty business is big. It's a real earner. And it's also growing like a weed, James. Those numbers are going up and to the right. As they say, and Qantas wants to get the earnings from this thing up towards $1 billion by the end of the decade. So it's amazing.
All right. So this is a big business, and loyalty is a big business. But the Reserve Bank of Australia, which does more than set the cash rate, which we talk about so much, and they're actually in charge of payments, and they're cracking down on something that could impact these points. Can you explain how all that comes together?
Yeah, so the banks, and I barely mentioned them before, but the banks, they're huge buyers of Qantas points. Like Qantas reckons more than, like you said, more than 35% of all card spend in Australia is attached to cards that have Qantas points linked to them. So that's a lot. Financial services, Qantas' biggest external customer base for these points, the banks and the Amex. It's hard to know exactly how much the banks spend on the points, but it's got to be hundreds of millions of dollars a year. Now, for the banks, this is a marketing cost, right? They need to offer these Qantas points linked cards to lure customers because, like I said, they are magic beans. The customers want them. Even if they don't know how to spend them, the customers want them.
Yeah.
So how do the banks pay up for them? One way is through what are called interchange fees. And this is where the RBA comes in. So every time you use your credit card to pay, whether it is a Qantas one or not, the bank will charge the merchant, so the person selling the goods, a fee of up to 0.8%. Now, the banks use those fees to help pay for the credit card businesses and everything it entails, interest-free periods, fraud, scams, issuing the card, etc.
Yep.
And leftovers are sort of freed up to offer gimmicks or rewards to customers, and that's where these points come in. But James, the RBA is clamping down on how much the banks can charge in those interchange fees.
Yep.
So at the moment, the cap is 0.8%. The RBA wants to make it 0.3%, which it says is like the actual cost of being a cards provider. So all this is going through consultation at the moment. The banks have put their submissions back. We expect to hear more in December. But through all this, James, I mean, it's a hot topic in banking. Do you think the banks will cut their ties with Qantas points? It's not even really in the discussion, right? They're talking about increasing fees on cards, increasing interest rates, cutting interest-free periods in response to these fee changes, rather than doing the obvious, right? Which would just be abolish the rewards programs. And why? Because these points are so magical. Customers are addicted to them. They love them. They love the idea of flying on Qantas planes allegedly for free. They love the idea of accumulating something for nothing. And the whole thing's just incredibly powerful for Qantas.
Yeah.
I spoke to a few of the main players about it for a column this week, and I thought it's pretty simple. I thought Qantas loyalty, it's going to get smacked here. The banks will just pull back.
But no.
Turns out these points, they're big customer retention tools as much as anything, James. It's how these retailers can get more out of their customers. They're also real big data weapons. They learn so much about their customers, what makes them buy, when, how much they'll pay for something as well. They can't really stop it. And so if you stand back and think what it really means, James, we're at this stage where customers are paying for their own Qantas points. They just don't quite know it.
Yeah.
It's quite astounding. They're giving the bank money and the bank's just giving the points back. So there's no free lunches, James, as we know. And the next time you get your monthly Qantas frequent flyer email with the points balance, just ask yourself what you think you really paid for those points and what value you're getting for them.
Yeah.
But James, this is all part of wider pressure on banks. The RBA's crackdown on payments. And the RBA seems particularly worried about the cost for small businesses, so it wants to reduce these interchange fees. What do you think the normal person on the street would think of the RBA clamping down on fees on payments just generally? Do you reckon the normal person's more worried about accumulating his or her points, or do you think they're worried about the money going through the system at the end of the day?
Well, I remember, Anthony, last year, the bank chief executives were dragged down to Canberra for their sort of semi-annual grilling. There was a few stunts where politicians would hold up like a coffee cup and they would say, so this coffee costs $5. Why, when I pay for it, does it charge me $5.16 or whatever the extra fee? And it's that extra fee that the RBA is trying to crack down on. They're saying no card surcharges. Banks, stop doing that. Merchants, stop doing that. But there's still a cost to accepting a card payment, and that's where those interchange fees come in. So, I don't know. I think psychologically, the public would see that, why am I being charged 16 cents to use my card at this cafe or retail outlet? That doesn't seem fair. So they'd love those fees gone. But I'm pretty sure they want to keep their magic beans, their Qantas points too. So, as you said, there's no free lunch. So one way or another, the banks will recoup the cost of these points. We'll still keep trying to earn these points like they're free, and we'll probably celebrate having these surcharges wiped out too. So politically, it's a pretty good solution. The problem for the banks, obviously, is they've got to find a way to recoup the cost of these points, and that's why they're sort of grumpy. But I think you're right. They won't stop offering the points. They're just so important. What all this says is these reward schemes, these loyalty schemes have really got their hooks into Australians. And we've talked about the biggest ones in the past. Can you run us through how important these have become for retailers and sort of which schemes matter most?
Did you know, James, there's an Australian Loyalty Association?
Of course there is.
Which publishes an annual survey of these things. Oh. So according to them, the biggest ones are Woolworths Everyday Rewards,
right?
The one that's linked to the Qantas Points.
Yep.
The Coles Flybuys, Qantas Frequent Flyer, and Dan Murphy's My Dan's. Yeah. So they're the top ones, ahead of Myer, Virgin Velocity, and then McDonald's My Macca's is the next biggest.
Yep.
It's funny, like you will hear if you listen into Woolworths or Coles Call or West Farmers or whatever, these rewards programs, particularly a couple of years ago, they were red hot, and then CEOs really still value them. They see them as an important part of the business. They're a big sort of customer retention tool as much as anything. It's how to get more out of your customers. They're very, very important, but they're not the only way to do retailing, James. Like we do see like Chemist Warehouses come from nowhere really in the past 20 years to carve itself out a huge piece of the market, and rewards programs aren't really its thing. So there are different ways to cut it.
Isn't it interesting though? Chemist Warehouse example is a great one. The rewards programs do cost something. Chemist Warehouse has decided to put those the savings they make from not having a rewards program into lower shelf prices, which everyone loves too. So as you say, there's different ways to do retail, but it's a fascinating topic, and let's see how the banks sort of wriggle their way out of this one. I think that's going to be really interesting to have a look at. All right, Anthony, we'll come back after the break and answer a big question about the big interest rate decision of the week. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, well, the week starts for us with the annual M&A conference in Sydney. We're doing a panel. We'll be hosting 3 big law firms, Allens, Herbert Smith, Freehills, Kramer, and King & Wood Mallisons. It's a hot topic at the moment, M&A, and the lawyers are a bit grumpy about all the regulatory burden they're dealing with, so it'll be interesting to get into that. On Wednesday, we get Australia's monthly CPI indicator, so we'll have another look at where inflation is tracking. Obviously, big news for the RBA. They're watching that very closely. And we're also getting into AGM season. Suncorp's AGM is on Thursday in Brisbane. What do you reckon will be focused on in the AGMs this year?
I reckon we'll still be looking at strikes for poor performers. It's been a real feature the past couple of years. Like last year, we had these blue chips like, CSL, Treasury Wine Estates, recording strikes. Goodman Group. We haven't normally see them at that level before, but Macquarie's AGM just came and went not long ago, James. They got another strike. So the strikes really still are on the agenda. It's going to be interesting to see what happens with climate plans as well. Yep. I know AGL's got its climate transition action plan up in front of shareholders. Feels like some of the heat around those votes, which is just indicative, has come out of the market. I think people are a bit more forgiving around the sustainability goals than they were a couple of years ago.
Well, the government's showing how difficult it is to get your climate plan in place. So exactly. Corporates have got to work in the same environment. All right, we love questions here on the Chanticleer podcast. This week, our questions from David in New South Wales. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, the widget on Chanticleer articles at afr.com is another way you can get a question to us.
Just quickly, James, I wanted to say thanks to all the readers that have been sending in questions. We've been getting a stack of them recently. We read them all, and mate, there's some great ones.
We love the engagement. So David asks, if the US budget deficit improves as a result of tariffs and concerns over long-term US debt eases, coupled with the reduction in Fed interest rates this week and possibly a dovish outlook of more cuts to come, won't this diminish any long-term concerns for financial markets and Magnificent Seven valuations? If the US economy picks up over the next 12 months, then realisation of revenue targets by the Mag 7 should be more likely, shouldn't it? Really interesting question from David here. He's referring to the big interest rate decision of the week by the Federal Reserve, so that's the US equivalent of the RBA. They cut rates by 0.25% to between 4% and 4.25%. seems to be the promise of more rate cuts to come. But actually, Dave's a bit wrong in that bond yields have been rising as a result of this. And that gets back to the idea that rate cuts tend to juice the economy, tend to heat the economy up, and inflation in the US might be about to head higher through the combination of a hotter economy and tariffs, right?
Good question from David. I mean, he's correct that the tariffs are raising money. The rates are coming down. You add in the one big beautiful bill and the tax cuts there, stimulatory. I mean, that's just locking what's sort of in the system already, all positive financial markets. But the problem, I think, in equity investors at least, they've already got their rose-coloured glasses on, and I think all that stuff's priced in.
Yeah.
So it's more of a case of what if this dream state, this soft landing, doesn't happen. But yeah, I think in terms of being positive on the Mag 7, I think they're showing quarter after quarter with their earnings releases, these things, they are growing, like there's serious momentum behind them.
I'm with you, Anthony. I just wonder, David, how much more good news can be priced into the Magnificent Seven's valuations? Yes, rates are coming down. Yes, the AI boom is in full swing, but these valuations have surged in the last 18 months. I just wonder how much better it can get. And what I think is not priced in is two things. One is that the Fed cut rates because the US jobs market appears to be cracking. What if they're right and the US job market does roll over? That's not priced in. And the other thing that's not priced in is any possible disruption to the AI boom. We're seeing huge amounts of capital being spent, something like $600 billion US this year from 4 companies alone, Meta, Alphabet, Amazon, and Tesla. Now, there's not a whole lot of revenue being generated out of that. And that's okay for the moment. We're in the if you build it, they will come phase. But what if the returns on that investment are shown not to be so great? Could sentiment turn? Again, I don't think that's priced in. So you might file this under what would I know, because the market just keeps going up and I've been bearish for a long time. But I just think it's always worth thinking about the downside. Part of the art of investing is thinking about the impossible, and I think that's worth thinking about. All right, Anthony, another big week. Sackings, fines, penalties, office romance, and magic beans. We can only hope next week will be as rich with possibility as this week's been.
We'll see what new ground we can break next week, James.
Fantastic. We'll see you all next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Mandy Coulin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.